All right, let's talk Forian. We're diving into their Q2 2025 earnings call from August 13th. And folks, this one's a bit of a head scratcher. You see a headline number like 56% growth, you'd expect fireworks, right? But the stock, well, it barely budged. So we're going to figure out what the market is seeing that the big splashy headline completely missed. And this right here, this is the central puzzle, a monster growth number. But the stock just sits there. So what gives? What is really going on under the surface? Okay, first things first. Let's get into the earnings snapshot and see how the hard numbers stack up against what Wall Street was actually looking for. So, revenue for Q2 landed at a cool $7.5 million. Now, that's not just a 56% jump from last year, which is huge, by the way. It also beat what analysts were expecting by about 4%. You really can't argue with that. It's a super strong top-line number. Then you look at the bottom line. Earnings per share came in at a penny. Now, okay, that was right in line with what everyone was thinking. But the really important part, this marks a return to profitability. They've swung from a pretty big loss a year ago to actually making money. That's a big deal. And if you want to see just how much things have improved operationally, look no further than adjusted EBITDA. It came in at just under $600,000. I mean, compare that to only $78,000 this time last year. That's a massive leap. It's proof that the business model is finally starting to get some real leverage. So, you've got all this great news, right? Revenue beat, back to profitability, soaring EBITDA. So what did the stock do? It went up a whopping 1.6%. And get this, the trading volume was 73% below average. This wasn't just a quiet reaction, it was basically crickets. It tells you there was zero conviction from the big players. The market just kind of shrugged. All right, to really get why the market reacted that way, we have to pop the hood and see what was actually driving these impressive numbers. And believe me, the story of this quarter, it really all comes down to one thing, an acquisition called Kyber Data Science. Yeah, and this chart just lays it out perfectly. So the company grew by about $2.7 million compared to last year. Where did that come from? A massive $1.9 million of it, that's 70%, came straight from the Kyber acquisition. The original business grew too, which is great, but let's be honest, Kyber was the real engine here. And check out how that revenue growth just flowed right down to the bottom line. Just look at the operating income line. A year ago, a $3 million loss. This quarter, they're in the black. That's a powerful swing, and it's exactly the kind of operating leverage the management team has been promising. And hey, don't just take my word for it. The CEO, Max Wood, he said it himself on the call. The reason their margins look so much better is because of two things. They've been really disciplined about their costs and, you guessed it, the impact of the Kyber acquisition. Now, it wasn't all about Kyber. Management pointed out some other good stuff too. They're building out their Chronos Data Lake. They're seeing real muscle in this area called health economics and outcomes research, and they're keeping a tight lid on expenses. Oh, and the cherry on top, a super strong balance sheet with over $35 million in cash. Okay, so this is where we get to the bigger picture, and really the heart of why the market is being so cautious. It's this classic tug of war between management's confident outlook and some pretty big hurdles they have to clear. So here's the bull versus bear case in a nutshell. The bulls are saying, hey, management just reaffirmed their full-year guidance for really strong growth. But the bears, and this all came out during the Q&A, are pointing out that the whole second half of the year really depends on some key contract renewals, plus they're seeing some shaky spending patterns from their customers. That's the risk. And this is the really crucial point you have to understand. We're talking about these Kyber license renewals. See, unlike Forian's usual business, which has multi-year contracts, a lot of Kyber's deals are just annual. That creates a huge question mark for the second half of the year. They absolutely have to get a high number of those customers to re-up if they're going to hit their targets. It's a total prove-it moment for them. But even with that uncertainty hanging out there, management laid out a really clear game plan. First up, in Q3, they're going to pay down the last of their convertible notes, basically clean up the balance sheet. Next, and this is the big one, they have to nail those Kyber renewals. And after that, use that pile of cash to maybe find another smart acquisition, all while keeping that organic growth engine humming. All right, so we've got the numbers, we know what's driving them, and we see the risks. Let's put it all together and give you our take on what we think is coming down the pike for the next earnings call. Which, brings us right back to where we started.
You've got a company that's clearly executing, but a stock that's just not getting any love. So is that disconnect a red flag, or is it a golden opportunity? We think it's an opportunity. But, and this is a big but, the road to a higher stock price, what we call a re-rating, is super specific. Step one, and there's no way around this, they have to deliver on those second half Kyber renewals, period. After that, they need to keep costs in check, show that they can sell Kyber stuff to their existing customers, and then finally, use that cash to make another smart purchase.
So, what's our projection for Q3? Well, based on their full year guidance, we're penciling in revenue around 7.3 million. That basically assumes things stay steady before the big chunk of those renewals hits later in the year. And for adjusted EBITDA, we're thinking around $200,000. That gives them a little room to make some strategic investments in data, something they talked about on the call. So putting it all together, our rating on Forian is outperform. We think the market is just way too hung up on the risk of those renewals in the second half. And in doing so, it's totally undervaluing what's really happening here, a successful turnaround of the entire business model. So to wrap up our thesis, you should probably expect the stock to be a little choppy as we get closer to the end of the year, and news, or even just rumors about those renewals starts trickling out. The thing to watch for, the real catalyst, will be an official announcement that they locked in a high renewal rate. Our core belief is this: the market is asleep at the wheel right now. If Forian keeps executing, this stock should get a major re-rating higher as everyone else finally catches on. And as always, remember, this is not financial advice.